Welcome, ladies and gentlemen. Commodity TV here for you in Zurich at the offices of Zurich Invest. And now we have a very prominent guy here, I would call it, from the gold scene. And Dr. Martin Murenbeeld from Murenbeeld and Company. He's the president. He's back. Welcome.
Yes,
because
thank you.
for years, I remember you've been with Dundee, right?
That's right,
and
yeah.
Now it's Murenbeeld and Company, so...
Yeah, no.
What happened?
Well, no, I joined Dundee in 2004. They were a client of mine, actually. I was a consultant prior to that. And in fact, for most of my life, I've been a consultant, other than teaching a little bit at the university, University of Toronto. And in 2004, the client decided they needed an economic function. You know, there was a wealth management arm of the company and so forth. So anyway, long story short, I ended up with them. Along the way, parts of the company were sold to Scotiabank and so forth. In 2016, after Dundee had downsized a fair bit, we realized that Dundee didn't need an economics function anymore. And frankly, I was going to just retire and maybe think about writing something, you know, just of a general interest about gold and so forth. And then a gentleman from Toronto, Brian Boss, contacted me, and he says, "Martin, there's interest in, you know, your reports. They were widely read. Maybe we should resuscitate those and go on a subscription basis." I said, "Well, okay, within certain guidelines, let's do that." And anyway, so that's what we've been doing since basically March or so of 2017. So we're about a year into the project.
Super.
And that allowed me to come back to Zurich. I missed last year, but I was here the year before on behalf of Dundee. And so it's enjoyable. And
exactly,
it's
you
good
are
fun.
back. So let's talk about the main theme, bullish on gold. You are a gold bug, I'm a gold bug. So why, in your opinion, we can be bullish for gold?
Yeah, no, that's a good one. But I'm going to just correct you on the gold bug. As an economist, I try to be very even-handed. I am sometimes bullish on gold. There are times when I wasn't bullish on gold. Hopefully, I picked the right times not to be bullish, and I'm picking the right time to be bullish. So the first thing I can say is, right at the moment, and for some time now, certainly since President Trump was elected, I have been extremely bullish on gold, and I'm probably the most bullish on gold that I can remember being, in terms of my strongly held feeling that gold prices are going to go up. Because, you know, when I forecast, I usually have a, kind of a scenario A where gold prices are not going to do well, and these are the ingredients of that scenario, and I put a probability on that. I have the lowest probability now on that scenario, and I have a fairly high probability on gold, getting well into the $1,400 and possibly even the $1,500 next year.
What brings you to that conclusion?
Well, there's a number of factors, but if I were to list the factors in order of importance, first is the U.S. dollar. I spent some time this morning at a presentation pointing out the impact that the U.S. dollar has on a great many number of commodities. In other words, when the U.S. dollar bottoms, commodity prices tend to peak, and when the U.S. dollar tops, commodity prices tend to decline. Now, I believe that the U.S. dollar peaked last at the end of 2015. And if you look at a chart of the dollar and you look at a chart of gold, that's very clear. So I think we're now into a bit of a bull run on the gold, and the key here is the dollar. Now, of course, some people will argue, and some investors certainly say, well, but the dollar's come down somewhat, but we think it's going to go back up. My view is that there is very, very little chance that as long as Trump is the president, that the U.S. dollar will rise. Trump, as I think we all know, is absolutely upset over the U.S. trade imbalances and what he believes, and many believe, is the bad deal that the United States has gotten from China and from some other trade areas, including Europe, right, on goods that the U.S. produces that they would like to sell. So, we're now looking at tariffs that he's introduced on goods coming from China and elsewhere and so forth. And so the first thing I point out is, a tariff is a currency devaluation by other means. Okay, because it raises the price of the imported goods. So it has components of a currency devaluation. So that's kind of the tone here, that this dollar isn't going to go up. It was interesting, just over the weekend, Trump tweeted that China and Russia are currency manipulators. Well, that just tells me more of what I believe is happening. They don't want the dollar to go up. They want the dollar to go down. Now, there's all kinds of studies, including studies by the Peterson Institute of International Economics, and one of the famous sort of tongue-in-cheek study by the Economist called the Big Mac Index, that indicates that the dollar is significantly overvalued. Yep. Okay, and so that's part of the trade problem. There are of course, various impediments to U.S. goods going abroad, but, if we go into a trade war, I tell you, the reason, the preamble to this trade war is a seriously overvalued dollar. So that's number one here, that the dollar has to go down. Number two is, as the U.S. is starting to make these shifts in terms of its terms that it wants with the rest of the world, there are going to be some shocks. So we kind of put them under the rug of, or under the classification of geopolitical crises and economic shocks and so forth. And so that's the other thing I expect to see, a lot more crises and shocks. Okay, for some presidential terms now, the rest of the world has kind of gotten a bit of a free ride. I was reminded not long ago by some quote I think that Bill Clinton made back in 1997 or thereabouts about, we've made an agreement with North Korea and we're happy to report that we never ever have to worry again about nuclear weapons in North Korea. Okay, and under the Obama administration, we made an agreement on Syria. We never ever have to worry again about chemical weapons. I mean, these countries, they just, but now you've got a president that says, you know what, it's got to stop. Okay, that creates frictions. Okay, and so we're going to see these frictions. So we're going to have frictions on the trade front. We're going to have frictions on the geopolitical front. We're going to have frictions with China over the South Sea, obviously North Korea. We've got frictions with Syria, right? Syria has the potential, depending on how it goes, of having a bit of a superpower face-off, between the U.S. and Russia. And that reminded me that the last time we had something like that was in 1980, and the gold price doubled. Went from $400 to $850. So that's another factor. This geopolitical crisis is going to create volatility, and in our forecast we add a geopolitical factor, which is about $35 or $40 on average. Because what happens, of course, with a crisis is the gold price pops up, right, and then it bleeds off. So not the full effect of the price is averaged in, but you get a bit. So that's number two. Number three, which is a background factor that I've been talking about for, 10 years at least, which is the global debt crisis. Now, back in the 2005, you could see this coming. People were going to retire at some point. The baby boomers were going to retire. And then the question was always, who the hell is going to pay for it all? Okay, and what are you going to cut if you're going to pay for that? Okay, well, that sort of summarizes down to the entitlement component of countries' budgets is rising dramatically. Now, entitlements includes unemployment, it includes old age pensions, it includes
health insurance,
everything, everything. The way the U.S. defines that is entitlements are payments to an individual for which no service need to be provided. Okay, so it's just a one-way payment. Now, I don't know if you know, but the U.S., and everybody thinks, the U.S. is low on entitlements. Well, over 65% of the U.S. budget is allocated to entitlements. Okay, now, it's of the same magnitude, of course, in Europe. So what's been getting cut is defense. In Europe, you got good infrastructure. In the U.S., they don't cut defense, but they've cut infrastructure. So now
streets are horrible.
That's right. Now we have that problem. See, so something needs to be done here, but without cutting entitlements, there's very little you can do except increase the budget deficit if you want to repair all these other things. You want, because Trump has asked NATO to up the defense expenditures, so that's got to happen. Okay, where's that money coming from? Well,
from heaven.
That's right, from heaven. That's where all these things come. And of course, heaven in this case tends to be the central bank. Okay, so at some point, we don't know when, we're going to have a significant debt crisis. Okay, and now Japan has shown us that this can be a way off, because the Bank of Japan has been buying government debt. It's now buying the stock market, right? So far, Japan is operating reasonably okay, right? But that's not going to turn it out here. No. If the U.S. increases its debt, which is certainly what the Congressional Budget Office is projecting, at some point it's going to have to borrow more money out of the market, and the market is going to say, hey, I don't know if I want to lend to the U.S. Okay, and
I think we saw it already.
That's right.
If China stopped to buy treasury bonds,
right. If the U.S. is having friction with these countries, that's the first thing China will say. And what will China do? I'm not going to buy, with our reserves, I'm not going to buy U.S. dollars. I'm going to buy another asset.
Gold.
That's one of the assets, and that's what Russia and China are doing. Okay, so now you got the problem that you got to fund all these debts, right? And where's the money coming from? Well, okay, well, that's okay, but it's not that the central bank, the Fed, wakes up one day and says, hey, guys, let's just print. No, it doesn't happen that way. Interest rates start to rise, okay, and that starts to slow the U.S. economy. Now, the Fed now has the dual objective laid down by Congress, right? Maximum employment at stable inflation. If employment starts to deteriorate, in other words, unemployment starts to rise, the Fed has to go easier, okay? So that's the kind of, and the ECB is in the same boat.
Absolutely. So they even cannot rise. It's not possible.
That's right. So you got huge debts in Southern Europe. Okay, maybe Germany will one day decide to make a transfer payment and forgive everybody.
Oh, Germany did it already.
Well, it's done it under Target 2, but this is not front and center to the voting public. The voting public doesn't understand Target 2.
Absolutely not.
But if the German government said, listen, instead of Target 2, we're taking X hundreds of billions and we're going to give them to Greece and Italy, that government would be toast.
Exactly.
Okay, so all of this is kind of going on behind the scenes, but we're building up a very, very large problem. So, global debts now at household, business, and government, I mean, we're starting to reach to 300% of GDP.
I mean, Argentina, when the last time bankrupt, is 310%, I think.
That's right. But the question is, countries like the United States cannot go bankrupt. They're not going to say, hey, I mean, Trump once said it, but that was a bit nonsense. The U.S. isn't going to say, oh, we owe you $100. You know what? We're going to give you 50 and forget about the rest. Okay? No, the U.S. is going to pay 100, but they're going to get the 100 from the central bank, and here you are. Here's the 100. Right? That's how it will, in simple terms, will tend to go.
Last question, because it's going to be really long now, but I love to listen to you, really. How about supply-demand situation within the gold market? How do you rate that?
To be honest, over the many years that I've looked at gold, supply and demand only interfere in the overall price profile, right? Intermittently. The key variables tend to be macroeconomic variables in the gold price. Okay, now I discovered this when I was building models for a company back in early 1980s. Most people that I talked to about that said I was totally nuts. They said, oh, it's demand and supply. I said, no, look at this. But anyways, demand and supply. Okay, where we saw a very significant impact was in the late 1990s when the central bankers were unloading gold. Okay, and that depressed the price of gold substantially. So there you had an impact of supply. Again, we saw this in 2013 when the ETF sector unloaded something like close to 1,000 tons of gold, and of course it had to be picked up by the Chinese and others, but at much lower prices. And those periods where you have accelerated supply for a reason that has little to do with, inflation, interest rates, and so forth, you have that. Obviously, if India tomorrow decided to buy no more gold because the law in India was you can't buy any more gold, well, they'd still smuggle it, but it would reduce. Okay, that would be potential. But as it stands now, I don't see any any sort of interruption on the general steady progress of demand in India, in China, and in Turkey and in other countries.
Or Germany even.
Germany, exactly. Exactly. And that demand is only stimulated by the fact that people are beginning to get worried about the dollar. Okay. And then on the supply side, you know, there is, of course, this thesis about peak supply. Now, peak supply, so that, in other words, the miners are not going to produce more gold. Okay, that's been around for, you know, a number of years, and so far miners keep producing gold. And I go to a conference and I say, well, there's a peak supply, but when I listen to each miner talking, they're all increasing production.
Exactly.
Right? So within reason, if mine supply goes up 100 tons or 150 tons over the next couple of years, it won't make any impact on the gold price.
Yeah, exactly. So that's balanced, like. Right?
That's right. Yeah. So I'm not at this point particularly concerned about the demand-supply situation. Super. It's pretty steady as she goes.
Yeah, okay, great. Martin, thank you very much. It was a great lesson in economics, and I really liked it a lot and enjoyed it a lot. So all the best, and we see us tonight at your big presentation, because I'm your moderator.
Oh, excellent. I'll look forward to that.
Super, thank you. Yeah, ladies and gentlemen, it was Dr. Martin Murenbeeld from Murenbeeld & Company. And yeah, you heard it. Interesting factors, interesting times for rising gold prices. Even he sees it also above the 1,500 level for next year, and yeah, we keep you posted on that. And maybe you should check out the Murenbeeld report, if I can say that.
Yes, absolutely.
Yeah, because very interesting.
Murenbeeld.com.
Murenbeeld.com, of course, and because Martin does a great report on there, and you're going to find a lot of more interesting themes. So thanks for watching us. Bye bye from Zurich.